and welcome back to AIBC Summit here in Dubai. Now joining me I have Kevin Murcko, CEO of CoinMetro. Kevin, great to see you.
Nice to see you, Jessica.
And
Good to be in Dubai.
Good to see you too. And for a lot of people that are watching, we've actually been doing interviews like this for about 2.5 years. This is our first in-person interview.
It is, yeah. We're a bit off social protocols right now, but yes, it is our first in person. It's good to see you in person.
Good to see you in person too. And if we take a look at 2021 and kind of like a year in review so far, I'd love to get your impressions because there's been a lot of key significant standpoints when it comes to price all-time highs. We've seen Elon Musk in the market. We've seen a lot of coins getting a lot of mainstream attention. What have been some of the standout points for you this year?
Well, I wish Elon would stop tweeting. I guess that's the first one. I think the year started off for a bang for almost any crypto platform. We went from, I think we saw 10, 50, 100x growth in many different metrics, and we're not alone. I think most crypto platforms saw those, whether they're exchanges or wallet providers. We had the mainstream media coming back in, as you said. We had this new kind of rush of retail, but at the same time institutional money, which was vocal and in the market. Elon Musk, you had MicroStrategy, you had all these businesses putting Bitcoin on their balance sheet, et cetera. And that definitely was interesting, and I think it fueled the first maybe 4 months of the year. Obviously, very recently, we saw a nice correction. I mean, the market's kind of like a rubber band, so when you pull it real fast and real hard, it comes back real fast and real hard. But I think we're at a point now where in 2017, when we saw that capitulation from 20K down to 3, we're not in the same market we were in. So we have matured a bit. We're still an immature market. I mean, if one tweet from one person can send the market tumbling, or one tweet from one government, or one news story that gets pushed around Reddit, that still means that there's a lot of retail influence. Retailers obviously trade differently than institutions. But I think we're light years ahead of where we were in 2017. So I think the market in a whole has grown, it's matured, and we're at a point now where potentially we are kind of at a cliff, where we either are going to become much more mature over the next probably 1 to 3 years, or we stay here. And I honestly think, I'm an optimist, and I'm usually not an optimist, I'm a realist, but I would say I'm optimistic here that the market is actually, for the first time, really, really catching a nice wave of maturity.
Fantastic. And you did mention there some of the kind of price fluctuations that you did mention because of this retail news. Is there a risk that the market has kind of outgrown itself in 2021 and we are at a bit of a cliff edge there? Because you mentioned even like 100x growth or expectations for exchanges. And there was even some issues when it comes to the market volatility, a lot of exchanges having to kind of halt trading or just not being able to keep up with the high demand they were seeing. I think it seems that the growth was higher than a lot of people expected.
Yeah, about exchange, I don't think it was actually the demand that stopped them from. So I think the retail public in general doesn't understand how markets work. If you look at traditional markets, you have things like circuit breakers, which I think we talked about at one point some time ago. So circuit breakers work where the market moves 20% usually downward only, which is a bit weird. If it moves 20% higher in one day, nobody stops anything. When it moves 20% lower, everybody gets freaked out. So they put the circuit breaker, it stops trading because they want to normalize trading. They want everybody who's scared or who's trading just in a panic to kind of chill out, calm down, and they bring the market back when they feel that it's appropriate, sometimes even the next day. But they do that because liquidity dries up, because everybody's on one side of the trade. So when everybody's selling, nobody's buying, thus there's no one on the other side of the trade. So the market, it's simply your spreads get very wide, gets more volatile, people lose more money. So generally, exchanges go offline not because there's too much demand. They go offline because they're probably sitting on one side of the book as well. Because to manage so much volume, they can't offset it to their liquidity providers, which means they're taking the other side of those trades. So when the market goes like this, they take a trade here, maybe they take a trade here, the market falls more, now they're taking risk. So they just go offline. Some exchanges don't, some exchanges manage that risk, but many, even the big ones, go offline when things like that happen. But I would say, in terms of just the general market, as I said, the cliff point is kind of, we're at a point where I think, it shouldn't be that one tweet or one message can upset the market. But again, retail flow is retail flow. And we need retail flow. If it's just institutionals, the market would do this. This would be the market. And it would get boring, and we wouldn't have the same volatility, and we probably wouldn't have conferences in Dubai because no one would really care about the market anymore. So it's important that retail money keeps flowing in. And I think it will. I think we're going to see ebb and flows of retail money throughout the next few years.
Fantastic. If we look ahead then for the next few months of 2021 and some key points, is there anything that you're looking out for that maybe is a kind of a concerning identifier or any expectations that you have for the industry?
I would say I'd be looking out for probably more regulation with what happened with this rubber band effect with a big correction. Now, anybody should have understood that if a market goes up, from literally 0 to 100 within a few months, it has to correct. You can't just keep going. Again, if everybody's buying, who's selling? So you need people, you need the market to come back to a point where people are willing to come back in the market and buy again at lower prices. So I would expect that what we need to see is, well, we probably will see, not that we need it, but we need it to a certain extent. But what we will see is regulators start to come out and put more restringent controls on the crypto market. So we've seen this in Hong Kong already. Hong Kong has already said that now only for crypto licenses, will only allow accredited investors or institutional investors, which is sad because the whole thing about crypto is access. Everybody having access, it being decentralized, disintermediated. Unfortunately, when things like this happen, and they're not managed in the correct way, you have regulators that react. So we've seen Hong Kong. We're probably going to see other regulators. I don't expect maybe US, UK yet to take really stiff action, but it's coming. You have European Union, which has something called MiCA, which is Markets in Crypto Assets, which they're trying to roll out. It's kind of like MiFID, if you're familiar with financial regulation, but for crypto specifically. And it's not out yet, which means they can still edit it. And I can almost guarantee you that it will get more stringent rather than more lax because of what happened in the last few days, in the last week with the market correction. Not because market corrections don't happen, because they know they happen. They're the regulator. They understand market corrections. But they understand as well that retail investors don't understand market corrections, and they get hurt, and they lose money, and they don't understand why. So I think we're going to see a rapid increase in vocal responses from regulators, and that's going to lead probably to, I don't think it's going to lead to a bear market. I think it will lead to some stagnant pricing over a few months. Though I think by the end of the year, we're probably going to inch back closer to the highs we saw before the last correction.
Okay, and when it comes to regulators' roles as well, there isn't really a cookie-cutter approach that we can take from the traditional, you come from a Forex background, from that approach, especially when it comes to, we saw the talks of, for example, influencers and regulators coming in and saying that actually, for example, Elon Musk, as you mentioned earlier in this interview, there needs to be some form of regulation when it comes to these promotional tweets that are advocating certain investment options. Are you expecting that to have some play when it comes to regulators taking action on aspects of the industry like this?
I think so, yeah. You look at John McAfee, who's currently in jail in Spain. I think they jailed him for tax evasion, but they're also now going after him for tweets that he made because he didn't say he owned assets when he tweeted and tried to pump their price. And I don't think that's the first person we're going to see with those type of charges. Elon Musk is a bit unique. I think Elon Musk understands a little bit about markets and how they work. These aren't regulated financial instruments. Depending on how you tweet, you can actually get around most financial regulation. It really depends. It can be down to one word, literally like the definition of if or that or it. And he has enough money to pay every lawyer that you've ever heard of to probably defend him in court. So I don't think Elon Musk will probably fall under the gun so much of the SEC, though they probably are investigating him already. But yes, the regulator's job really is to police not just the market, but police how the market obviously is marketed to individuals. And this market is marketed to individuals in absolutely the wrong way most of the time. So the narrative is usually wrong. The narrative is, buy this dog coin, buy this meme coin and become a billionaire. And that's the wrong narrative because those things are short-lived. They only go up because people aren't selling. The minute people sell, they die. I mean, that's literally the way those type of assets work. So I do think, aside from just policing the market, you exactly will see more of the regulator coming out and being, and when I say the regulator, we're talking probably the top three. So you're probably talking the FCA in the UK, you're talking the SEC, maybe CFTC in the US, and potentially even the Japanese regulator, even though they're not as vocal as others, Australia even. But yes, I do expect there needs to be. Unfortunately, people don't understand sometimes when things are in jest or that it's more akin to gambling than investing. And they truly believe if they put they're only 100 euros, they're only $100, they're only 100 pounds into this investment, they're going to become a millionaire. Mm-hmm. And that's absolutely ridiculous. And we need to educate the public, and that's part of the regulator's job.
Fantastic. And that was actually a really great point. So maybe just as a summary then, because obviously we are welcoming new traders and new investors in this year, and there is a lot of clouded information, and it is very difficult to find some core new values when it comes to learning how to invest or how to get started. What kind of key messages could you give to a first-time investor or trader that is looking to sign up to a platform and doesn't really know how to start?
Sure. I would say look at equities as an example. So most people that invest in the stock market don't trade. They hodl, right? The hodl mentality didn't come from crypto. That's equities. Equities go up every year, 8, 10, 12%, because people don't trade. If everyone that had money in the stock market traded, the stock market would be worthless. It'd be a zero. The stock market would have $3. It would have no value. So you shouldn't be looking to trade. Trading is kind of like, I think I've made this acronym somewhat, no, actually not an acronym. I made this, I can't remember the name, but I've made this kind of comparison a million times. I'm going to make it again because maybe I should have a new audience. So, it's kind of like brain surgery, right? So you're sitting next to your wife, your husband, whoever, at a dinner table, and they fall down and have an aneurysm, and you go, wait a minute, I read this book. And then you break out, Brain Surgery for Dummies. You read page 1, 7, 12, and 18, and then you're going to crack the skull open, and no one's going to do that. That's ridiculous. That's exactly what people do with trading. They read How to Trade Bitcoin, they read paragraph 1, 7, and 12, and then they jump into it, and they put all their money in, and they think they're going to become, a billionaire within 2 weeks. It's not how it works. It takes years. It's not something you can learn immediately. It's literally against human nature to become a good trader, because you have to be able to go against human nature, which is difficult to do. You need to be very patient. It's a psychological game. So I would say start with looking at assets that you understand the business, you understand maybe some of the tokenomics behind it, how those coins function. Put money in those and sit on it. It's money that should sit there. It's a long-term investment. Don't play the market, because you probably will lose like 80% of the retail crowd that tries to trade.
Great. I'm sure that was actually really useful information. I definitely took some mental notes along the way. Kevin, thank you so much, and enjoy the rest of the conference. It was great to catch up.
Thank you. Bye-bye.
Thank you. That's all from myself and Kevin, but we'd love to hear how you found this segment, so share your thoughts with us.